Thanks. I'm not sure if I was put on the agenda at this stage because the topic of climate change might be even more depressing than the state of small cap markets. So I'm hoping to leave you with a little bit more optimism about some of the trends and the work that we've been involved in. So my job here today isn't to pitch our company. We are active in this space. We are listed. I want to tell you a little bit about some of the trends that we're seeing in what we call nature-based solutions to climate change, how that links to the sort of narrower world of companies meeting their net zero obligations, which is a thriving and growing source of demand, but also maybe change the way you think in your heads about why we do these kinds of investments and what some of the drivers are. So just very simple basics of what nature-based solutions represent in terms of climate change. The big goal for stabilizing the planet's temperature by maximum of 2 degrees increase is to reduce emissions by 15 to 18 billion tons, so 15 to 18 gigatons. And if we do that, if we're able to do that, then the scientists tell us we should be able to stabilize emissions at no more than 2 degrees centigrade. Just people don't necessarily understand what that means in the context of big changes in things like ice ages. So the last ice age, the average planetary temperature change was about 7 degrees centigrade. So when we talk about a 2-degree increase in temperature, think about it as being like 1/3 of the difference that an ice age makes. Now, my scientific colleagues will drag me out of this building onto the streets for making simplistic statements like that, but it gives you a sense of the order of magnitude of effect size in terms of temperature increase by 2100. And the thing that's often missed when we talk about climate change is that 20% of global emissions come from land use change, land degradation, deforestation. Again, we tend to think about the solution to the climate problem as being how do we stop emissions from cement plants and aviation and data centers. But a big driver of increased CO2 levels in the atmosphere, increased methane levels, has been land use change, and tends to be the neglected category. If we look, there's a fantastic book called Why Forests, Why Now, which does the best cataloging of the effects since the beginning of the Industrial Revolution, and they make the point that fossil fuels have resulted in about 375 billion tons of emissions since the beginning of the Industrial Revolution. In that same time, 180 billion tons of emissions have come from land use change, from deforestation and land degradation. So we think about these often in markets as being minority effects and small effects, but 20% of global emissions is 5 times larger than the cement industry. It's almost 10 times larger than all emissions from aviation. So stopping land use degradation, deforestation, and thinking about ways of restoring forest cover, mangrove cover, all of these areas represents the lowest cost solution in many cases, in almost every case, to climate change. Now, the cost of direct air carbon capture and storage is a minimum of $100 a ton, more like $150 a ton. It turns out nature developed this great technology hundreds of millions of years ago called photosynthesis, which is far more efficient at pulling carbon out of the atmosphere and locking it up in plants, in soils, in oceans, in mangrove sediments. So when we think about mobilizing nature-based solutions, what we're talking about is mobilizing very, very large-scale forest protection projects in as few as 7 or 8 countries around the world, and in mobilizing very large-scale land restoration, changes in agriculture. And in terms of a cost per ton, whereas capture and storage might be $100 to $150 a ton, those projects are viable at less than $20 a ton. So we think about different sources of climate finance that can flow into creating and supporting nature-based solutions. Now, the ones we're most familiar with is carbon credit markets, but they're not the only way that these things can get funded. Again, I should probably be dragged out and flogged for a diagram this big with a font this small, but you're going to have to forgive me. This shows the cycle of carbon through all the different systems on the planet: the atmosphere, the surface of the oceans, the soils, fossil fuel reserves, vegetation. And the point here I make is that about 8 gigatons of carbon per year comes from human fossil fuel and industrial emissions. To put that into the context of where all the other carbon is in the system, there's 450 to 650 billion tons of carbon in above ground vegetation and biomass. There's up to 2,400 billion tons of carbon in soil. There's 900 billion tons of dissolved carbon in the surface of the ocean. So again, the way we think about this is how we can redirect the way that nature works in small ways across these ecosystems and these chemical and mineral systems to absorb more carbon from the atmosphere. So our impact is small relative to the stabilized fluxes of carbon through these systems. What we see sort of at the high level, and this is something that's sort of counter to most of the trends in the market, is still very high levels of demand and investment from carbon credits coming from initiatives like GFANZ, led by Mark Carney and his teams, that represent net zero strategies for $68 trillion worth of assets. The demand, the leading edge of the demand for voluntary investments in carbon is coming from companies that represent about 33% now of global market capitalization, that have established net zero targets as ESG goals, and where regulators in the EU and SEC have said, well, if you told investors that's what you're going to do, show us your plan. How are you going to achieve these goals? And I would say at the moment, the leading companies in terms of driving capital into these areas is oil and gas sector, who are under pressure from shareholders to do something with the very strong profits they've seen in the last 2 years. The technology sector, companies like Amazon and Apple, who are very sensitive to consumer pressure to address emissions from data centers. And to put it into context, any one of those individual companies has committed between $200 and $500 million into investing into nature-based solutions on a very large scale. And in my experience over the last 2 years, none of the leading investors into that space, none of the big buyers have reduced their demand. They've got more cautious about it, a little bit more risk averse in terms of project selection, but the capital is sitting there, and that ranges from $200 million at Apple for their Restore fund up to in the range of $500 million in companies like Shell and BP. So that's one source. The other source of optimism is we may gradually see the UNFCCC process, the COP event in Dubai, setting aside the irony of an oil-rich nation hosting a climate solution conference, that we're seeing progression towards a globally regulated investment framework for countries to meet their climate obligations through regulated markets. And if we're able to institute Article 6, the big source of negotiation, ultimately we should see at least a framework for money to flow into these projects. Now, my skepticism about that will be the same as yours. In recessionary and challenging economic conditions, are we really going to see countries like Germany, the US, and the UK move money offshore into what's effectively international development projects? So I think we can get the framework. It takes leadership from countries like Norway, who have invested in advance into these projects, to really capitalize that market. Just to give you a sense of some of the brands that on the voluntary market side that are active in this space, you can see the list here. As I said before, 33% of companies, 33% of the world's market capitalization has made these net zero commitments. What is a nature-based solution? In simple terms, you can pay people to not cut down the trees and protect and create conservation areas in areas that would otherwise be deforested. You can restore and reforest areas, and we're involved in we've planted almost 2,000 hectares in West Africa of native forest, very affordably, providing huge amounts of employment to local people, paying smallholders leases on their land. We have what's called blue carbon projects, which are primarily mangrove protection and conservation. These mangrove areas are key also for battling sea level rise and flood events. They're incredibly productive. They store 500 to 1,000 tons of carbon dioxide per hectare, and they're one of the real areas of focus at the moment in terms of DFI investment, government investment, and then these voluntary markets. And then agricultural projects where we change land use through things like no-till agriculture, regenerative agriculture, can have massive impacts in terms of enhanced carbon sequestration. We're seeing that being built into public policy in the US and in Canada, where farmers are paid for more proactive carbon sequestering agricultural practices. When they're not being paid, they're often just being regulated. And there's been a lot of progress in that to enhance that kind of sequestration. The slightly uncomfortable news when you look at the places where this works best is also in some of the least developed countries in the world. This map just shows the 8 countries that have the highest potential for avoided deforestation and reforestation. Many of those countries across Central Africa are known to be challenging places to work. There are also places where you can secure land rights quite easily. 80% of the land is held by smallholders, and aggregating smallholder contracts is one way to get to very large land areas. We have 57,000 hectares of smallholder contracts under option, and it's hard work, but labor costs are low, so you can get this done. Why is all this potential in tropical areas? I live in Vancouver. People always ask me why we don't do more local projects, and it's very simple. Land is cheap, labor's cheap, and the trees grow 3 times faster in the tropics. Most of the carbon loss has happened in the tropics. Most of the gains are going to happen in those parts of the world. So places like DRC, Angola, but in West Africa, Sierra Leone, Guinea, Guinea-Bissau, Liberia, Ghana, all have huge potential for securing firm, constitutionally protected land rights and restoring or protecting these land areas. The challenge for the developers in this space has been that there's a huge amount of untapped potential. The sector is organized like if you compare it to the resource sector, it's more like sort of artisanal scale businesses. Compare it sometimes to the Yukon gold rush in Canada, where everyone showed up and started panning in streams looking for gold. And what you need is large scale, industrial scale in some ways, resource sector mobilization. So you're seeing companies now, including our company, think about large-scale land concessions, benefit-sharing agreements and contracts with governments, having governments as partners where there's public concessions, and then scaling up both the use of Earth observation data, digital observation systems, drones, all the way through to full traceability systems built around distributed ledgers and blockchain transfers, so that the buyer can trace their carbon all the way back to the original smallholder. So we're seeing this kind of mobilization, very much in parallel with what's happened in every other resource sector, start to happen, and to take what's been a sort of cottage industry up to being a much larger scale industry. The economics of these projects typically are quite attractive from an investor's perspective. In the current market, which is very short of supply, you can spend as little as $500,000 to $1 million characterizing the potential reserves in a 200,000 hectare project site, doing the science, the measurement, and the management. Once you've made the investment into the project, you get a 30-year annuity stream from trees that are protected or trees that are growing. So the CapEx ratio to revenue streams, is 25 to 30x return on capital. The buyers in the market are setting up pre-purchase and option agreements. We've seen the big buyers move upstream and say, as we did with our commercial agreement, we'll pay you in advance to purchase these credits, and you then get to use that capital to invest in the project development. So effectively, a zero cost of capital as long as you get the right pricing in the market. So very, very proactive movement by large corporates and by governments to say, we need to mobilize this kind of investment into these solutions. Some of the big precedent transactions, not ones I was involved in, but was close to through some of our partners. Delta Blue Carbon Project in Pakistan, restoring 350,000 hectares of mangroves, producing 150 million tons of carbon a year. To put that into context, Canada's emissions are about 700 million tons per year, so a very large-scale project. And then a company in the US called Wildlife Works secured a $200 million investment line from Hartree to invest in large-scale conservation projects. In terms of the return profile, restoration projects give you this slow, classic S-curve of growth as the trees grow over sort of 8 to 10 years to their sort of maximum productivity, and that then continues for 80 to 100 years. Conservation projects, you get these big savings from the avoided emissions up front. So this kind of mix of projects means restoration and conservation projects are highly synergistic. This is what I think are some of the key structural financing solutions in the market, which are going to support the mobilization of more capital, both from governments, from philanthropic organizations, and from buyers. One is just that in the old days, people used to just do community-level projects, ignore the government, fly below the radar, and governments have realized that there's a potential gold mine in carbon projects, and they want to know what their share is. You know, and where you've got public concessions involved or publicly owned land, it's absolutely right and correct that the government at the national or sub-jurisdictional level should know what their benefit sharing agreements are like. You'd never build an LNG plant or an oil concession without government first agreeing to what its share of the revenues were. And believe it or not, that hasn't happened in carbon until the last couple of years. That's why Zimbabwe intervened in carbon markets, and Indonesia did as well. It's why in the DRC there's a national carbon regulatory framework. So these are starting to emerge. The rule sets, the scientific and technical foundations of projects are stabilizing and improving all the time. We expect to see things like reserve-style statements for carbon projects where you can project out and have validated the way you would with a geologist what the future reserves or production is going to be from these sites. There's a lot of work to address and clarify land title and land ownership issues, especially in things like mangrove projects, which are often in areas where there was no prior use for the land. It's most often public land and it's very rarely private land, but you need this clarification on who actually owns the underlying title. There's a lot of investment at the moment in upgrading monitoring through satellite technologies. I've been an advisor to a company called Earth Daily, which is launching a satellite platform next year, which will monitor every square inch of the Earth's surfaces once a day at 10:30 a.m. and capture, every aspect of biomass growth and support, almost continuous monitoring of tree growth through those systems. And that's unprecedented. That supports the scaling of many of these systems. We're starting to see interest in insurance products and derivatives and financial instruments that create forward curves for carbon pricing and nature-based solution investing. The market's still in its infancy in many ways for that. But we have seen World Bank programs like MEGA start to think about how they can develop products and support for these markets, which I think is really important. And then lastly, just in terms of the structure of the buying, a lot of the focus last year and prior to the contraction was on building new carbon exchanges to allow for high volume trading and speculative trading and highly fungible tokens and assets and rights in carbon. In practice, the verification validation systems are very well established. They've been around for 20 years. When a project is validated, it's validated to reasonable standards of assurance by effectively audit firms. So the rulemaking is pretty stable. Most of the transactions are OTC. 70 or 80% of the volume is large corporates or large buyers or countries coming in and buying entire projects. So what you see often traded on the startup exchanges is often the sort of leftovers or the edge trades that nobody else wanted. The big transactions are a company like Microsoft coming in and buying most of the credits from the Sindh province project in advance and locking everything up. And we've seen the same from the oil and gas companies. I sort of joke that it's as much as we're moving into a true commodity market, it doesn't behave like a commodity yet. It's more like wine appellations than a true commodity. The buyers want very specific project types from very specific regions, and often they want input into the design of these projects. So what you don't have is all the producers around the world, as you might have in something like lithium and gold, being able to aggregate up and wholesale and mix these credits from different markets and sell them as blended instruments. The buyers are very specific about their taste and preference for the large-scale projects. There's very intensive due diligence because when Apple buys or Amazon buys or makes an investment in a restoration project, it's their brand and reputation that's out front and at risk when they do that. And we've started in the last 8 to 12 months, I'd say, with the large commodity traders trying to work out how to participate in this space and allocating capital to it. And this is true of Hartree, Glencore, Mercuria, Trafigura, and Macquarie. All have built desks around this to figure out how to get ahead of demand. So we're starting to see intermediary capital flow into these projects at a significant volume. And that's sort of my general message is I'm optimistic about nature-based solutions because they're scalable projects, and in a 10-year time frame in 7 to 8 countries around the world, we could lock up the production of 70 to 80% of the total nature-based solutions in the market. That's a tangible, fungible problem that we could solve with better contracting, better intergovernmental discussions and negotiations. And I think even out of the UN process, we're going to see just more direct bilateral contracts of the kind that Norway put in place with Guyana, where nation states will come in and say, we're just going to fund this and fund you directly to do that, because this is part of how we manage our own liabilities and risks. So I'll stop there. And
thanks, James.
Thank you.